everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. Every week, of course, we are bringing the VRIC to you with our series of expert online panels. We have a follow-up to one previously that was very popular. We're going to be getting into technical analysis and charting when it comes to commodities today. And we are joined by Patrick Karim and Kevin Wadsworth of NorthstarBadCharts.com. Gentlemen, it's great to have you back. We're going to talk about gold, silver, copper. I'm looking forward to diving into it.
Yes,
Hey Jesse,
Jesse.
thanks for having us back on.
Yeah.
That's right.
Awesome to have you both back on. Let's start with gold. It is the most popular commodity on this channel. Some would call it a monetary metal and not a commodity, but we'll call it a commodity today. Now, we all know the story, gold at nominal all-time highs. However, it's been consolidating for quite some time. We've seen it dip a little bit recently. I don't think this is anything people need to be alarmed about, but I'm wondering, in both of your opinions, are we due for a breakout or a breakdown? And Patrick, I'll start with you.
Oh man, I was sure you were going to choose Kevin. I was going to take it easy, just chillax. So, all right, fine, okay. You want to do it the hard way? I'll let the charts do the speaking, and I'm sure Kevin's going to put some color commentary on that. So, your first question: people, they're in gold, stackers. Okay, they don't care about price, but you're a trader. Some people either they got in, Jesse, here at the beginning of the bull market back in June of 2019, or some people they bought during this consolidation, or they bought on the breakout here on the close of November. This is a monthly candle charts, guys. So every candle has 1 month of data, and people are just writing it go up. And gold has been a beautiful trade because it's just been trending nicely above the 12-month moving average. Not much worries or stress, and just kept going up and up. Now people are saying, well, okay, what's happening here? Is it, are we done at the end of the road? Well, I could answer that in two ways. One way is the classical TA way, classical technical analysis. So you have measured moves, you have a pull, flag, and then got a pull. You add that measured move, and usually that's the energy into the pattern, compress, moving averages. They tighten up. Nobody believes in gold anymore. It even did a false breakdown here, scaring everybody. And look at what it did. So now, from a classical TA perspective, gold has reached its target around the 3K. It's done. So anybody wants to know, but these measure moves off, they could overstretch. Sometimes they undershoot, but most of the time they hover in that area. So while the price did shoot up, guess what happened? Not too high above, guys. The price went sideways. So from a TA perspective, it's a classical TA, it's stretch. From a trend analysis, that means I'm using a moving average. Look at that 12-month moving average. I haven't closed below it yet. So it's still an uptrend. People could still be riding this since late November and say, I'm only going to exit once I lose that trend. So to answer your question, how are we about to lose that trend? Well, here you could look at the distance from the 36-month moving average. So the bottom pane is the distance from that red line. And look at it. I'm going to show you historically. We're an outlier situation right here. This is the 70s. Here's 2006, 2008 before the GFC. Here's the 2011 before the huge bear market. Here, it couldn't get that high on the previous rally. Look how stretched it was. It was crazy FOMO here, and people were getting upset at Kevin and I on April, where we're telling people, guys, hold on. We're not telling you it's the end of the ride, but we're telling you that we're stretched. So while people, they want to jump in April, the time to jump in wasn't in April. The time to jump in was June of 2019 and December of 2023. If you miss those entries, I'm sorry, you missed them. I can't create low risk entries for you. So we're stretched. But now, as months has gone by, check it out, Kevin. The momentum is slowing down. So the price, as it's going sideways, the rising moving average, that 3-year moving average is catching up. I'm going to highlight it for you guys real fast. So the price wants to catch up to this, and that's this line. If we close below this valid rising trend line here, we are in a monthly defined correction. So right now we're going sideways. There is we're having a hard time here at this level, guys, at the 3,325 level or maybe a little lower. We're having a hard time getting above that. If ever we close below that line here, so the price is not able to reaccelerate, it's 100% correction mode. And now you could be looking at something more nefarious, a retag of the rising 12-month moving average, which is at 2,925. And if that fails, then you could even expect a retag of the 3-year moving average inclining eventually. And that will create the next low risk entry. So as this goes down, it creates the next breakout line. You see right here, you see here when you're coiled and tight to the moving average, will be the next low risk entry. So I hope I answered your question. Is the correction going to continue? Well, it's getting really close right now, but we're just stretched. It's like, what can we tell other people, Kevin, there? Another way, maybe another analogy to help people understand where gold is at there right now.
Well, yeah, I mean, as you said, the elastic band is stretched, so people can get angry with us for not being able to identify a low risk entry point here. But as you quite rightly said, you do not find low risk entry points when the price is stretched from its long-term moving averages. So it depends on your methodology and it depends on your mindset, whether you're a short-term trader, a long-term investor, or a stacker, as to what you do at this point. But clearly, there is a significant risk, a significant threat that the price of gold is either going to go sideways in time to get closer to that moving average, or it's actually going to be pulled downwards in direction to close up that distance with the longer term moving averages. Now, I know some people will be looking at this saying, well, yes, what about the 1970s? You can see that the distance from moving average went much, much higher. And if it does the same now, it'll just ignore what we're saying and the price will keep going up. Well, one thing to say about that is if you're an investor and you're invested in the gold market, that's great. No worries. We're not telling you to sell as an investor or a stacker. There's no reason to do that as long as we're in a long-term, well-defined precious metals bull market. So if you have long-term positions, should these short-term corrections are, it's not a point for selling necessarily. It's a point where you might want to consider taking an opportunity to add at a reduced rate. That's very different to a trader who doesn't have a position in gold and who wants to take a short-term position in gold. So, the question that you asked, the way that you answer it and how you tackle it depends very much on your own mindset and your own risk attitude and all that kind of stuff as well. But we cannot, as Pat said, we cannot create low risk entry points. This is not a low risk entry point, but it does not mean that the price of gold isn't going to continue grinding upwards. It could very well do that, and we could be in some kind of completely different paradigm where the price of gold just goes on up to $10,000, $12,000 without any significant corrections. But the probability of that is low. And as traders and investors, what we try to identify is what is most likely. We're not trying to identify what will happen, because we have to accept, however clever we think we are, we don't know what will happen, but we know what is most likely to happen by studying history and by studying the relationship of gold and silver and gold to the US dollar and gold to the stock markets, all of these interrelationships. We can work out what's most likely to happen. So what's most likely to happen at the moment is that we have an extended consolidation for gold, or we gradually start to move into a corrective phase.
I'll show you just here the daily chart, maybe for your viewers, they might appreciate. So this is the daily chart for gold. 1, 2, 3, 4, 5 points. That's a valid rising trend line. And look at the moving averages. These are the 12-month, the 12-day, and 36-day. The blue one, the 12-day, the red one. So gold, probably here. Yeah, okay, here's my breakout line. So gold is close to losing. So it's going sideways. That's the correction. It's losing rising momentum. So until it closes back above, and I'll tell you guys exactly, until it starts getting a daily close, solid daily close above 3,435, you don't touch it. It's like there's no low risk entry, even on the daily time frame. So even if the daily time frame does break out, you're still in outlier territory on the hard time frames. But if just somebody wanted to trade this here, it's having a hard time. And sometimes you got to be wary of these breakout lines here because it's stretched on the hard time frame. There's a lot of downwards pressure, a longer term downwards pressure that doesn't want this to break out right away. It wants it to go sideways or maybe down. So it's, did we talk, Jesse, back in December? What were we saying back in December of 2023 there? We have to go review the tapes there, but I'm pretty sure we were pretty aggressively bullish back then. And now we're less so. We're trying to be the voice of reason, and we have been since April. And yeah, guys, that's just the way it is there. Sorry.
Well, let's touch. Yeah, no, that's Great summary from both of you on the setup for gold at present. I want to talk about silver. It's been holding strong above $35 for some time now. The narrative out there from people, whether they're into technical analysis or not, you hear that if silver can break and remain above $35 for a sustained amount of time, that's going to be a launch pad where $50 is the next target after $35. Is there any truth to that statement? How do you see things?
Yeah, I've got the screen sharing on there, so hopefully you're seeing the silver chart. And
Yeah.
the long-term roadmap is something that we probably discussed last time. If you review those tapes, because this roadmap was issued back in I think 2020, about 5 years ago now. And silver, as everyone's now aware, is in a large cup and handle pattern. The cup portion of it started in 1979, and it's a sort of a 45 plus year cup and handle pattern. And if we zoom right in on the handle portion of it, you can see what's happening at the moment. And this is the chart that we put out there back in 2020 for people's patience, little bit of patience to follow what would happen. We'd had the COVID low touch point, and that's what created this sort of arc pattern. It kind of confirmed that the handle on that big cup was itself forming in the shape of another cup. Sometimes these handles they tend to be a little bit varied, I suppose, in the way they form, and sometimes you don't even get handles on these cups. The price can just shoot up out of the cup formation, the basing pattern, and we've seen that with Bitcoin in the past, where the price just shoots off to the upside. But it was very clear that we were forming this pattern, and therefore it was guiding us nicely to this target area around about the time frame that we're just about to enter, really sort of late 2025, early 2026. So we've got a close now above the $35 resistance level. I was actually highlighting $34.66 as an important number. And you can see the technical indicators. This is the stock RSI at the bottom, but many of the technical indicators look similar, with higher lows and trending towards, well, what Pat and I discussed before this interview actually was the word opportunity. Jesse, we talked about the word opportunity, because whilst gold is not breaking down, we don't need to particularly talk about gold going on a new significant upside run. But whilst it doesn't break down, silver has an opportunity, and in fact, the broader markets have an opportunity when you look at the stock markets and when you look at cryptocurrencies as well. Sort of a risk-on type of environment, and silver quite likes it when the stock markets are doing well. Silver has its best run, in fact, after stock markets have bottomed and they start to recover. Silver outperforms pretty much everything after stock markets have fallen 50% and start to recover. So silver is a recovery metal. You've probably heard that before. And there's an opportunity here, clearly, for silver to have a nice little spike into this target area, whether it's 40, 45, 50, or whether it actually exceeds that target area a little bit. But you can see how the technical chart pattern is guiding us nicely into this area. So what I would say is that as long as silver is above rising moving averages, or above the rising daily support lines and weekly support lines, then the trend on those timeframes is maintained. But somewhere up in this top right hand corner, given the weight of evidence from other aspects of technical analysis, I would expect to see silver moving upwards pretty strongly, and then correcting quite significantly. And I think it'd be difficult to avoid some sort of reasonably significant correction after silver spikes, if it spikes upwards to the, let's say, 50 to 60, 65 area. Let's just say it does that. Then that would sort of fit in with other market indicators around what's quite likely to happen with markets as we move forwards over the next few months. So all is good with silver at the moment. I'd be quite, I think the probabilities are in favor of silver progressing further and continuing towards this target area before we get a significant correction or pullback. So long term, silver looks good. And in fact, longer term, as you look at it sort of more sort of macro perspective, as I said, with an expectation that the markets might start to run into trouble in the not too distant future because of a whole load of other things, like unemployment numbers ticking up, the current situation with debt dynamics and the 10-year yield minus the 2-year yield, the yield curve inversion, all those kind of elements are pointing towards issues and strong big problems coming our way. So, silver is taking advantage of a sort of a window of opportunity before all of that becomes apparent, and quite possibly cryptocurrencies and stock markets doing the same. So I'd be optimistic in the shorter term, but then expect a period of problems before the really exciting stuff comes. Now, if we were to look at, for example, silver versus the S&P, in fact, I can just do that for you. This is an important exercise just to get rid of any fear of missing out that people might have, any FOMO that people might have. If we do, what am I doing here? Silver versus the SPX, and we just look at that ratio chart. What it does is it gives us a little bit of a perspective as to where we are in all of this. And if I just zoom right out, see the cycles that silver has. When silver goes on its massive bull runs, as it did in the 1970s, and it did in the early 2000s, when silver, went up by many hundreds of percent. Silver rising from $4 or $5 all the way up to, wherever it was, near $50. So you're getting silver going up 7, 8, 9 times. Now, we haven't even really broken out versus the S&P yet. You could draw a resistance line on here, something like that. And the time to turn bullish, and here's a little tip for people. If you pull up a monthly chart, the time to turn bullish longer term is when the chart is above the long-term moving average. In this case, we've got, I think it's the 36 months. No, it's not. It's the 48-month moving average. So price needs to be above that moving average, above the Ichimoku cloud. That's this red and green technical indicator, and above the key breakout lines. So you can identify what we call a cluster of evidence, an evidence cluster right there. And when the chart moves through it, we'll be into a bull market, just as we were here. Excuse me, and just as we were back here. Do you see the similarities? The chart moves through the moving average, through the cloud, boom, silver goes on a massive bull run. And the same with the breakdown. You can see the breakdown here, and you can see the breakdown there. So these long-term monthly charts that tell you when and when not to sort of be excited about a market. So no matter what you might be seeing on social media at the moment, and no matter if silver moves to $50, even by moving to $50, this chart of silver versus the S&P will barely have begun to move the needle. It'll barely be through that zone. And just think what silver's going to be when the ratio chart comes back up here, or heaven forbid, if the chart comes all the way up here again, the price of silver, you'd be talking about multiple hundreds of dollars. Even to get to here, you're probably talking about, I don't know, $200, $250 silver, something like that. So, there is absolutely no need to feel any FOMO for the silver market. And that the same goes for the miners as well. People are looking at gold and silver miners. There's absolutely no need to feel that you're missing anything at the moment, because those ratio charts tell us that we are so early, so early, Jesse. It's not even started yet.
If Kevin have done SPX price in silver, like the inverse, the SPX lost like over 80 or 90% of its value in the 2000s in over 10 years.
Yeah, and also another fact that people may not be aware of is that gold versus the Nasdaq peaked 25 years ago. If you look at Nasdaq versus gold, it actually reached its peak 25 years ago and has never recovered. We're still down something like, what is it, Pat, 40% or 45% down?
Yes, and from the 2021 highs, we're down 21 or 24% from the 2021 high. So for the past 4 or 5 years, the Nasdaq is still 25% below its peak. That means it's gone. It's the fiat illusion there. Kevin and I do say that word often, and maybe you do, Jesse, or your other interviewees. It's a fiat illusion. Oh yeah, Nasdaq's going up, but is it really? Is it really? If silver is outperforming you, Nasdaq, you're treading water. You're not going anywhere.
And that's a key assumption that we make for our for traders and investors, is that we have to assume that you're holding your position in precious metals, particularly gold, because, and we've been saying this for years, and I'll say it again, we are in a precious metals bull market, on the cusp of being able to say that we're in a precious metals bull era when we get the S&P breaking down. Okay, so we're in a precious metals bull market. That means that gold is outperforming the US dollar. So do not, if you've got a load of wealth, right? A load of dollars. Why you wouldn't be holding it in dollars? We're assuming that you're holding it in gold. So that is the base assumption because that wealth held in gold has pretty much doubled in the last 18 months. Now, another way of looking at that is that your purchasing power has been destroyed in US dollars. The US dollar purchasing power is being destroyed. So it's that illusion that Pat's talking about. Gold isn't going up in value so much as the US dollar is collapsing in value. So the base assumption is that you hold your wealth in gold. From that point onwards, what you want to look for is what is outperforming gold, not what's outperforming the dollar. I'm not interested if the S&P or the Nasdaq is outperforming the dollar. I'm not interested because I know that gold is outperforming the S&P and the Nasdaq. So why would I be looking at the S&P and the Nasdaq? Except perhaps, if you're talking about a 401k or if you're talking about dividends and that kind of thing, I accept there are arguments around those. But by the time you've taken those into account, you can also beat those returns by using precious metals related instruments and other commodity related instruments. So the point that I'm trying to make here is that during a precious metals bull run, hold a core position in gold, and then additional allocations need to be made to what is outperforming gold. So just pull up your chart of stock X or stock Y priced in gold. If you're looking at, let's say, Apple shares or shares in Microsoft or something that seems to be doing quite well, don't price it in dollars on your trading view chart. Price it in gold, and then you can see whether you should be buying that particular stock or not. If it's not outperforming gold, look elsewhere because there will be some things. Platinum will probably outperform gold at some point. Silver will outperform gold. Palladium will outperform gold. The miners will have a period of outperforming gold. But if you just want to protect and grow your wealth, gold will do the job. If you want to double up on that in protection and double up on that growth, or triple up or quadruple up for periods of time, look at uranium miners, look at zinc miners, look at copper miners, look at tin, aluminum, whatever. You can name your commodity, the oil, energy, they will all have their periods where they break out versus gold. So you can take those allocations and play those markets with a portion of your wealth. That's the way to play a precious metals bull market and bull era.
Well, you did mention copper there. I'd love to touch on that because it's getting close to nominal all-time highs here. I haven't checked in the last few days, but it was getting there the last time I checked. How do you see the copper market playing out when it comes to the charts? Patrick, I'll turn to you for this one.
Let's do it. The charts do not lie. Only humans do. Or is it it's not guns that kill people, it's humans? I don't want to get political, but it's like Kevin and I were always searching analogies because we're trying to relate this information to people because, it's like so some people, like back in the days, like if I would have talked to science in back in the medieval days and there's a scientist trying to explain to them like physics and all that, and we go, what? It's like, what? That's, you're talking about astrology for men, it's witchcraft, whatever.
Yeah.
With TA, technical analysis, we're there not to educate, to talk down people, but to show them that, to mitigate their expectations of what TA is, because there's a lot of snakes, oil, whatever there. They say TA, breakout, confirm my money. They show portfolio, the numbers, all that. It's not about that. It's about establishing probabilities. And because we've seen and we were not the ones who invented it. There's a TA book that 100 years old, the Japanese used to do this to trade rice with Japanese candlesticks.
Yeah.
So it's all about probabilities. And it's right before the call, Kevin and I, we looked at the, was it the monthly copper chart, Kevin? Yeah, I think so, right?
Yeah.
There's a clean breakout there. I thought maybe it was a high time frame. Yeah, copper broke out back here, even here. It broke out, retested a breakout line, a huge wick all the way down to the 36-month moving average. And it's just trending upwards now. So yesterday on Twitter or whatever, I did, what happened to copper? It's up 10%. People, it's Trump. No, it's not. I guess maybe on the short term, it was like an instigator. It was already trending upwards. It was already doing higher lows since 2020, 2022, 2023, 2025, higher lows. And now it was hitting a wall here, compression, like a resistance line. That's why it's important, permitting the moving averages to catch up. And look at that, bam, the breakout actually happened in March, on the close of March.
That resistance line, by the way, people listen to that and they'll say, what are you talking about? A wall, a resistance line? It's just a stupid line on the chart. That line that Pat's put there, it identifies the point at which traders, and I'm talking about human traders and the algorithms, the computer programs that are trading automatically, they have set a price point there that has created a level of resistance. Every time the price hits that level of resistance, the copper chart is sold off. So clearly there are sellers at that level. So all these lines, when we put a line on the chart, it's not astrology for men. The lines are identifying regions of buyers and sellers, volume, if you like. You can put the volume profile, which Pat's got on the side of the chart there. It shows you where the buying and selling volume is. It shows you where the buyers and sellers will step in. Now, if the price can overcome one of those levels where the sellers are willing to sell into strength, if the price overcomes that, then the market recognizes that. Both buyers and sellers will recognize that, and they will bid the price up because they recognize that that level of resistance has been overcome, and it's not resistance anymore, it's support. So everybody starts using that level as a support level, not a resistance level, and price can move on up to the next either resistance level if there's already price resistance up there, or in this case, because there isn't price resistance up there, you're then using a number of techniques that include measured moves, which Pat's just putting on the chart there, using the flagpole technique, which is energy in, consolidate, energy out. It's a process of physics, which works very well with buying and selling in markets. Or you can use another way of doing this is also reflected through Fibonacci level, and you can use Fibonacci extension levels as well that also give a good back of the envelope kind of guide as to where, roughly speaking, where the price may pause and consolidate. And it works very well with precious metals and works well in most markets. So there are a number of techniques, and there are others as well, that will identify where you're likely to run into some resistance. And once you're into clear sky territory, you can play the trend. You can choose your moving average, which has been supporting the price on the way up, choose your supporting trend line, and then just stay in the trend until that trend line is broken. So you can ride a trend potentially up, 2 times, 5 times, 10 times, however high it decides to go. And we, of course, don't really know exactly how high it's going to go. But yeah, so that's that. I just wanted to say there that these lines on the chart, they're just not some kind of imagined lines that we put on, but it's also worth pointing out that drawing charts like this and putting the lines on them, that is subjective, because you'll get 2 different technicians who may put the lines in slightly different places. And very often it's not a single line that you need to be looking at. It's more a zone of support and resistance. So you need to be a little bit realistic about it and not expect the price to just instantly turn back because it hits a line that you've put on the chart. Aside from those lines, you have moving averages, the Ichimoku cloud, and other technical evidence which are not subjective, they're objective. So they are there courtesy of the mathematics of it. The 12-month moving average, the 36-month moving average. It's not up to me or Pat to decide where they go. They go where they do because of the price chart itself. So you have to be able to understand the difference between objective and subjective elements that are put onto a chart for you to look at. If it's a line that someone's drawn themselves, then it's very much subjective, and it just adds to the evidence.
It's like people say the charts, the past performance is useless, but you got to remember who's buying and selling in the future. These are people, half of them at least, are people who bought before, who exit. So somebody who's buying today in the present bakes in a sell, guaranteed in the future there will be a sell eventually, unless the guy holds and event 10 years. So that's why it's important the past. You got to study the past, because you got to study where people bought and sold in the past. And then you can know in the future, when are these people probably going to sell? So that wall here that Kevin, like that wall there, the market telling you can't go above. Well, who do you think is selling here? It's these people who bought down here, who bought the breakout. And then all these people here, I'm reaching my profit. Or they have 10 billion to sell. They put a limit there. Okay, they sell, then the price goes down, then the price goes back up. Well, the guy still has a billion shares to sell. It hits it until that guy who bought at the bottom, who sold everything. And it's not always like naked short sellers. They're trying to manipulate the price. It's people taking profits also, people got to see both sides of all these sellers. But once all they're gone, once this beautiful sideways move is done, and these guys at the bottom are gone, Then you get the new batch here bought in this thing, and they ride it all the way up. If it's meant to continue, and if ever the price does falter, whatever recession, something happens, it pulls the price back down, then you exit, you know. But this is a low risk opportunity. Actually, 3 months ago there was a breakout here, so it's the up move. Jesse, it's not happening today. It's happened already 2-3 months ago. And what I don't like about these headlines driven spikes, because when I saw that 10-15% or whatever gain was yesterday was starting to get sold into, I don't like that, because often when the price stretched on the higher time frames and you get these sell the news events on the short time frames, that marks a top. But here the price isn't that stretched yet for copper, so there's still hope that whatever news headline driven we had on the short time frames won't create enough damage to kill this trend. Because remember, we showed you this at the beginning of the, look how copper is able to stretch here before, you know, hitting important tops. We're still in the uptrend. So this is it's positive news for copper that this news induced whatever move yesterday was simply going to be a non-issue there, because a higher time frame is still trending upwards.
Great points. I'd like to just end real quick here on the broad market. I was going to start with it eventually, but I wanted to start with gold. So I'm wondering what both your thoughts are on, you know, we've seen the NASDAQ and S&P hit new all-time highs in fiat currency terms. Kevin, you were pointing out it's important to watch it in gold terms. So what's going on in terms of gold? Because another thing to point out is that the broad indices have actually not risen much this year, especially compared to commodities, yet still hitting new all-time highs. We saw that dip after the tariff announcements. Obviously, this is a headline-driven sell-off. What are your thoughts on the action in the broad market and where you see it headed?
You're asking me, Jesse?
Either one of you, whoever wants to tackle it.
Yeah, well, I mean, you're right. The S&P is at new all-time highs. The S&P priced in gold and stock markets priced in gold look very different, of course. We can take a look at those charts if you like. Or Pat, do you want to cover this one?
I have one. I could do it right now.
Yeah, go on, Pat. You go for it.
Check it out. So I did this one recently there. This is the NASDAQ priced in gold. And this is important because while the NASDAQ is in a bull market in price and fiat, it is not anymore in a bull era, because it's not outperforming gold, right? Just like the opposite, gold's in a bull market, but it's not. So now it's a battle. Who's going to be in the bull era next? And look at this chart here. This is NASDAQ losing a 1, 2, 3, 4. It's a clear breakdown. It's like people forget stuff that happens there because there's a rally for the past 3 months. But there was a clear breakdown of this rising trend line in favor of gold versus. So now we're hitting a wall here. So it's fine. So this line, guys, is my final breakdown line. Horizontal lines always more meaningful because they guarantee that you have a new swing low. So that means it's a new downtrend. Rising trend lines, while they break down, it does not guarantee that you have a new swing low, right? Because the swing low is that going to be at a horizontal plane. But look at the distance for moving average, 1.23. Breakdown way before here. Enter correction mode versus gold. NASDAQ goes sideways. And now it's actually, goodness, it's losing stuff there. It's starting to lose. I'm telling you, this thing is very vulnerable for a move down once it goes. Goodness, where's my squiggly line here? Once it maybe retags the 3-year moving average here, and then it's very vulnerable to do that. And I would only get bullish the NASDAQ, like a bull era type, you know, once it closes back above maybe this line. Jesse, I'll zoom in for you guys. If ever it's able to, this is support turn resistance. This is just natural resistance. And then you got the death cross, 2 moving averages. If ever the NASDAQ's able to really overcome this and you know, go back above, then of course, let's say it's able to do that. Then of course, here you have to become bullish NASDAQ, and the thesis of gold, like it's everything's going to unravel for everything else. If that happens there, it's going to be, you know, Bitcoin, NASDAQ, all that, gold going to go hibernating. So, but this right now is just a back test. The momentum is still failing here. It's terrible. This is a rising momentum line in favor of NASDAQ since 2003. That thing's dead. And until, yeah, eventually there'll be a line here. So you got it. And it's not stretched to the downside. So also there is still room for NASDAQ to get underperformed by gold. So bias is neutral, and it gets really bearish for NASDAQ here. And the high likelihood that if NASDAQ goes back below this ratio, so 6 ounces of gold or 6 shares of NASDAQ for 1 ounce of gold, if ever close below that, it's probably going to be because we're in a recession and the markets are tanking. That's probably going to, we're looking for that. It's historically, these bull eras and commodities have always been instigated with the stock market tanking, not 15% tanking or 30, 40%, bam. That instigate the destruction of purchasing power, the total public debt for the government, stimulus, bailouts, all that stuff, man. On the recovery side, silver just munches that up, man. Rocket ship, 2, 3, 400%, outperforms everything in your pathway. That's what commodities react to. It's all that money printing to save the economy, but it hasn't happened yet there. So the SPX needs to break down price and fiat. It's not happened yet.
Well, gentlemen, this has been a great conversation as always. Patrick, tell us about NorthStarBadCharts.com, what it is you do there, and where people can find it. Obviously, they can find it at NorthStarBadCharts.com. So take that part out of the question. Just tell us what it is you do there.
Thanks, Jesse. Well, Northstar Bad Charts, we dedicate it to our members. We do chart requests, market roundups. It's crazy. It's like everything you see us doing in these interviews, we do it day in, day out, and communicate with our members. I don't know, Kevin, do we give them a promo code? You think they just they like that?
We can give you a promo code. Yeah, I think if anyone contacts us and mentions the show, we'll be happy to give a 50% discount. Yeah.
Great. So they should reach out by email and let them know, let you know that they saw this program.
Yeah, or just DM us on X. You can find Pat on X. He's at BadCharts1, and I'm Northstar BadCharts on X. So yeah, just reach out to us, and if you mention the show, we'll give you a good discount. But yeah, as Pat said, we cover a lot of ground on the website, and of course we give trade signals as well, and we cover all the markets, cryptocurrencies through precious metals and commodities and everything else in between. So and we enjoy what we do. So we hope that we pass some of that enthusiasm on to other people as well.
Great. I'll put a link in the description to NorthStarBadCharts.com as well as both of your X profiles so people can reach out to you via DM for that special offer. Thank you both so much for coming on. I cannot wait to do part 3 in the future.
Nice stuff, Jesse. Thanks a lot.